Welcome to the deep dive. Today, we're trying to cut through some of the market noise. All the talk about potential recession, tariffs causing concern, investors feeling a bit cautious.
Yeah, it's definitely a time where people are maybe pulling back a bit, thinking short term.
Exactly. So we wanted to focus on the longer view. The Motley Fool recently highlighted 3 companies they think could be breakout growth stocks over the next decade.
Okay, interesting. Which ones?
AppLovin, Datadog, and ServiceNow.
Right, okay. 3 tech players.
Yeah. So our mission today is really to dive deep and understand why. Why these 3? What are the core reasons they're seen as promising long-term bets, especially given, the current climate? We want to pull out the key insights for you.
Makes sense. It's actually often in these uncertain times that you can find companies with really strong fundamentals, companies positioned for that longer-term growth if you look closely. These 3 definitely have intriguing stories.
All right, let's start with AppLovin. Now, they're in the mobile world, but it's not just about making games anymore, is it? What's the core business now?
That's right. They did start out publishing mobile games, yeah. But the bigger part of their business now, the main driver really, is helping other app developers make money.
How so?
Through their advertising technology.
Yeah.
They've got this really sophisticated platform. Think of it like an engine for matching the right ads to the right users within apps.
Okay.
And while they still have their own games, that ad engine is where the major growth has come from, especially after they bought MoPub and Whirl back in 2022.
Those acquisitions. So that expanded their ad tech reach.
Hugely. Yeah, it broadened their networking capabilities even into areas like connected TV advertising with Whirl. It really shifted their center of gravity towards ads.
So this ad matching engine, what's the secret sauce? The report mentions an AI-powered AXON ad discovery service. That sounds important.
Oh, it's absolutely key. AXON is, well, think of it like Netflix recommending shows, but for mobile ads.
Okay, I get that analogy.
It uses AI to analyze just massive amounts of advertising data.
Wow.
It learns which users are likely to click on or engage with specific types of ads.
So it predicts performance.
Exactly. By predicting which ads will give the best return, they can attract advertisers who want efficient spending. It's about using AI to make the whole process much, much more targeted.
Which naturally brings more advertisers to their platform.
Precisely. Better results for advertisers means more business for AppLovin. It's a powerful cycle.
Got it. Now, they're also making some big strategic moves. I read they might be selling off their gaming side. And they put in a bid for TikTok. That seems ambitious.
It does, doesn't it?
Yeah.
Selling the gaming segment would signal a real laser focus on that higher growth, probably higher margin ad tech business.
Right.
Lets them concentrate resources.
Makes sense. And the TikTok bid, even if they don't win it.
Well, even if they get outbid, it shows massive ambition.
Right.
They're thinking big. Imagine plugging their ad tech into TikTok's enormous user base.
Wow, yeah.
It really highlights this trend where ad tech companies want direct access to huge audiences. So yeah, even the attempt is significant.
Okay, let's look at the numbers. How's their recent performance been?
Pretty remarkable, actually. In 2024, revenue was up 43%.
43%. That's substantial.
It is. And their adjusted EBITDA, which is a good measure of core profitability, especially after those acquisitions that jumped 81%.
81%. Okay.
Yeah. And looking forward, analysts are projecting between 2024 and 2027 about a 20% compound annual growth rate for revenue.
Still strong.
And 31% for adjusted EBITDA. So they're expecting that profitability engine to keep accelerating. These aren't small steps. It's significant expansion forecast.
But that potential doesn't come cheap, I imagine, the valuation.
Right. The enterprise value is around $105 billion, and it's trading at about 28 times this year's projected adjusted EBITDA.
It's 28 times. That feels high.
It's definitely not a value stock, no. That multiple suggests the market has already baked in a lot of that future growth.
So the risk is if they don't meet those high expectations.
Exactly. But if they do keep hitting those numbers, if AXON continues to be as effective as they hope, then maybe that valuation looks justified down the road. It's a bet on execution and that AI edge in mobile advertising.
So the long view depends on them staying ahead in AI ads and making these big bets like potential acquisitions pay off. The report also mentions stock volatility. Where does that come from?
Well, a few things. Growth stocks in tech are just inherently more volatile. Price swings are common.
Sure.
Then you add in AppLovin's aggressive strategy, like bidding for TikTok creates huge uncertainty. Markets hate uncertainty.
Right.
Plus, the whole mobile ad world is constantly changing. Platform rules shift. User behavior changes. Any bumps there could hit their stock. So, yeah, expect a potentially bumpy ride.
Okay, that paints a clear picture for AppLovin. Let's switch gears to Datadog. Now, for someone maybe not in the IT trenches, what's the core problem Datadog solves?
Okay, imagine a big company's IT setup. It's super complex, right? You've got applications, servers, cloud infrastructure, databases, networks, tons of moving parts.
A digital spaghetti bowl sometimes.
Kind of, yeah. And traditionally, IT teams needed separate tools to watch each part. One tool for servers, another for the network, another for application performance. It's inefficient.
Lots of juggling.
Exactly. Datadog offers what's called an observability platform. It basically brings all the monitoring data from all those different parts into one single place.
Ah, a unified view.
Precisely. Instead of checking 10 different gauges, IT teams get one comprehensive dashboard showing how everything is working together. It makes spotting and fixing problems way faster.
That sounds incredibly valuable, like moving from isolated sensors to a central control room.
That's a great analogy. Massive efficiency gain. And they're not standing still. They've got this AI tool, Bits AI. How does that fit in?
Right, Bits AI. It's basically like an AI assistant built into the platform.
Okay. Because Datadog is collecting all this performance data, Bits AI can analyze it automatically to help figure out why something went wrong and sometimes even suggest how to fix it.
So it helps diagnose issues faster using AI.
Yeah. Like if an app slows down, Bits AI could sift through the logs, correlate events, pinpoint likely causes. Yeah. It makes the IT team more proactive, less reactive. They're embedding AI right into that core IT workflow.
Interesting. How's this showing up in their financials?
Pretty healthy. 2024 revenue grew 26%. And importantly, they're landing bigger fish. The number of customers paying them over $100,000 a year grew 13% to over 3,600.
So bigger enterprises are buying in.
Yes. And their profitability improved significantly. Net income nearly quadrupled. So they're scaling efficiently.
And the forecast. Analysts see a steady 20% compound growth for both revenue and earnings per share through 2027. The report called it a maturing business, but still with lots of runway. What does that mean?
Well, they're not like a brand new startup with maybe 100% growth, right? It's more established.
Yeah.
But the need for what they do, observability, is just growing and growing.
Why is that?
Because companies keep adding more complexity. More cloud services, more microservices, more digital tools. The more complex IT gets, the more critical it is to have a unified view. So even though Datadog's maturing, the market they serve is still expanding rapidly. There's plenty of room to grow.
And the report mentioned their limited presence in China is actually a plus right now.
Yeah.
Because of trade tensions.
Yeah, that's an interesting point. In the current climate, with trade disputes and potential tariffs or regulations, having heavy exposure to certain regions can be a risk.
Right, adds uncertainty.
Exactly. Datadog's focus on other markets means they're somewhat insulated from those specific geopolitical headwinds, which investors might see as a source of stability.
Okay, let's talk valuation again. Enterprise value of $33 billion, trading at 10 times this year's sales. The report says not cheap. So why would investors pay that premium?
Well, it's similar to AppLovin in a way, but maybe less extreme. The market often gives a premium valuation to companies that are leaders in essential growing markets.
And observability is seen as essential and growing.
Definitely. Market projections suggest that whole observability space could grow at nearly 20% per year for the next decade. Datadog is a major player there, known for innovation, strong customer base. Investors are likely paying up for that leadership position and the expectation of continued strong growth in a critical market.
All right, that makes sense. Let's move to our third company, ServiceNow. What's their core mission? What problem are they solving for big companies?
ServiceNow is all about streamlining how work gets done inside large organizations. Think about all the messy, often manual processes, onboarding a new employee, requesting IT help, handling customer service issues.
Yeah, lots of emails, spreadsheets, phone calls maybe.
Exactly. Lots of friction, things falling through the cracks. ServiceNow provides a cloud platform to digitize and automate those kinds of unstructured tasks into smooth, efficient workflows.
So taking internal chaos and making it orderly and digital.
That's a good way to put it. The aim is to get rid of redundancy, cut down on manual work, lower costs, and just make things run better, especially now with so many hybrid and remote teams.
And like the others, they have an AI component, Now Assist.
Yep, Now Assist. It weaves AI capabilities right into those workflows they manage.
How? Like chatbots.
Yeah, things like chatbots to answer common HR or IT questions automatically, AI that can analyze IT data to predict potential problems before they happen, automation that can just resolve simple requests without needing a human.
So making the automated workflows even smarter.
Exactly. Driving more efficiency, more productivity, more cost savings for their customers.
Now, one really interesting angle highlighted was ServiceNow's resilience. Apparently, it offers value whether the economy is booming or busting. How does that work?
That's a key part of their appeal. When the economy is good, companies want to grow efficiently, scale up smoothly. ServiceNow helps them do that by streamlining everything.
Okay, and in a downturn.
In a downturn, the focus shifts hard to cost-cutting and doing more with less. ServiceNow helps there too by automating tasks, reducing manual labor needs, optimizing how resources are used.
Ah, so it helps with efficiency and cost savings. That's a strong pitch regardless of the economic weather.
It really is. It makes them seem like a more stable bet through economic cycles. And like Datadog, they also benefit from having no direct sales in China, insulating them somewhat from those trade worries.
Gotcha. What about their recent numbers? How did 2024 look for them?
Solid performance, revenue up 22.5%, and they saw really strong growth in large deals. Customers with over $5 million in annual contract value jumped 21%.
So they're deepening relationships with big clients.
Exactly. And their adjusted earnings per share grew 29%. So strong profit growth alongside the revenue.
Okay, analysts are forecasting around 19% revenue growth and 27% EPS growth annually through 2027. But the valuation, 59 times forward adjusted earnings, that seems quite steep. Why the premium?
Yeah, 59 times is definitely up there. The argument for it really rests on that consistency and resilience we just talked about.
Because they're so embedded.
Exactly. Once a big company builds its core internal workflows on ServiceNow's platform, it's really hard and disruptive to switch. It's sticky, mission critical.
So predictable revenue streams.
Very predictable, yes. That stability, combined with their consistent growth track record and their position in driving digital transformation with AI, well, the argument is that kind of quality and resilience deserves a premium valuation, even if it looks high on the surface. It's seen as a core long-term tech holding.
Okay, so wrapping this up, we've looked at 3 quite different companies picked by the Motley Fool as potential long-term winners.
Yeah, quite distinct focuses.
We've got AppLovin really pushing the boundaries of AI and mobile advertising, not afraid of big, bold moves like acquisitions.
Right, high growth, maybe higher risk-reward profile there.
Then Datadog, providing that essential unified view observability for complex IT systems, increasingly powered by AI assistants.
More of a foundational tech infrastructure play, tapping into that growing complexity.
And finally, ServiceNow, the workflow automation engine, digitizing internal processes on the cloud, designed to be valuable in pretty much any economic environment.
Yeah, focus on that enterprise efficiency and resilience. Very sticky business model.
So despite all the current market uncertainty we mentioned at the start, the common thread here is that all 3 are seen as growth stocks poised to potentially outperform over the next decade, tapping into powerful trends.
Exactly. Even with the headwinds, the argument is these companies are riding strong secular waves. AI, cloud, digital transformation, the need for better data visibility.
This has been really helpful in understanding the why behind these picks. It gives you, the listener, a framework for thinking about these specific companies, but maybe also about identifying similar long-term potential elsewhere.
Absolutely. And perhaps it leaves you with a final thought to consider. Think about those core drivers we discussed. AI transforming specific industries like advertising, the non-negotiable need for IT systems monitoring as complexity explodes, the relentless push to digitize every workflow for efficiency. How might these powerful forces, the ones fueling AppLovin, Datadog, and ServiceNow, reshape other sectors? Where else might these trends create compelling investment opportunities in the coming years? Something to chew on.